In section 2, we're going to talk about the regulations that are in place to protect investors and to improve stability in financial markets. And we're going to start with some early efforts that were made. We have the Federal Reserve Act of 1913. What this act did was establish the Federal Reserve System, and the Federal Reserve System, or also we refer to it as the Fed, it has the primary responsibility for overseeing the U.S. banking industry. The Banking Act of 1933, this established the Federal Deposit Insurance Corporation. You have probably seen this on banks, FDIC. This ensures bank deposits. It prohibits commercial banks from selling insurance or acting as investment banks. And you may hear this act referred to as the Glass-Steagall Act. And back in 1933, it ensured deposits up to $2,500, which was a lot at that time. But now it insures up to $250,000, and so if you have more than that, you would want to deposit it up to $250,000 at each bank. Then you have the Securities Act of 1933, and this was the first regulation on the securities industry. It required firms that are issuing new stock in a public offering that they had to register with the SEC, which is the Security and Exchange Commission. And this act and the Security Exchange Act of 1934 was the government's response to the 1929 stock market crash, and this crash ultimately led to the Great Depression. You also have what I just mentioned, the Security Exchange Act of 1934, and this dealt with securities. It regulated that the SEC would oversee the securities industry, and they still do to this day. This is a federal agency, and it has the primary responsibility for regulating the securities industry. So the SEC reviews quarterly and annual financial reports that all publicly traded firms with at least 500 shareholders and $10 million in assets are required to file. Brokers and dealers also have to register with the SEC, and the SEC has the power to prosecute individuals and any companies engaging in fraudulent securities market activities, such as insider trading. During the 1980s and 1990s, there was some deregulation, and it temporarily reversed the course that financial markets were on. The Financial Services Modernization Act of 1999, it overturned the section of the Banking Act of 1933 that prohibited commercial banks from selling insurance or performing the functions of investment banks. So a little bit of deregulation there. We had the Sarbanes-Oxley Act of 2002, and we talked about that in the accounting chapter. I also talk about this a lot in the accounting class. It ensured that external auditors will offer fair, unbiased opinions when they examine a company's financial records. And that act is still in place. We also have the Dodd-Frank Act of 2010. So here are we had a little bit of deregulation, and then we had to jump back and say, no, we need to still regulate some things. We need to regulate the auditors, the external auditors, to make sure that they are being fair. And then in 2010, it said, okay, the feds need to regulate authority over non-depository financial institutions. So remember, these are institutions that get their funds from investing anything other than deposits that we discussed earlier. Now, the financial institutions I just mentioned, these also could be non-depository. Some examples would be hedge funds. Mortgage brokers is the one that I think of the most. And I want to mention that the Dodd-Frank Act of 2010, it also created the Financial Stability Oversight Council. And what they did was identify risk in the financial sector before they led to a crisis. So try to prevent some issues in the financial markets. Try to be more of a preventive instead of reactive. And here's just something to think about. After reading about the laws enacted by the U.S. government to regulate or deregulate financial institution activities, would you say that more regulation or less regulation is better, and why? And also think about that we want to keep businesses at a level playing field. So we want business growth, but we also have to have things in place to keep those that don't play fair in check. So that's just something to think about.